Risk manager workflows on Aladdin begin with daily risk reporting to provide oversight across a broad set of funds. With this information, risk managers can drill into outlier risk figures and conduct analyses on what might have contributed to the risk numbers in question. Additional use cases include conducting stress tests through the creation of prospective market changes, running trend analyses to observe fund trajectories, modeling what-if changes to a portfolio, comparing ex-ante risks to realized returns, and many more. Additionally, users can export data directly into Excel for ad hoc analyses. Aladdin even offers an Excel plugin, known as ATX, to help stitch together broad data sets for customized risk monitoring and analysis. In this overview, I will assume the role of a multi-asset risk manager and showcase how Aladdin can help investigate monthly risk changes from an externally managed fund in a multi-asset portfolio group. The portfolio risk model on Aladdin seeks to determine the downside loss of a security, sector, portfolio, or portfolio group based on exposures to market risk factors by answering the question, what is the maximum amount my portfolio could lose with a given degree of confidence over a given time horizon? These market risk factors are explanatory factors used to represent the volatility or standard deviation of a security's returns. More risky assets have a higher volatility of returns. In other words, larger fluctuations in gains and losses. Similarly, less risky assets have a lower volatility of returns, or smaller fluctuations in gains and losses. Accordingly, securities with a higher volatility of returns should be associated with factors that have a higher volatility of returns themselves, or these securities will have greater exposure to a given factor. Ultimately, a factor model is utilized to create intuition around where a portfolio evidences over or under exposure to market indicators, being that common themes and risk bets can be more easily identified along factor dimensions and security dimensions. Moreover, a factor-based model handles the complexity of new issued securities that have no historic pricing data. With a factor model, historical returns are based on factor levels, not security pricing. Consequently, a new security in the marketplace can be modeled and evaluated on a risk basis even if there is only a single price available. The fixed income and equity risk models on Aladdin are covered in corresponding asset class specific user videos. So here we will discuss the suite of alternative risk models offered on Aladdin. Aladdin provides model coverage for hedge funds, private equity, infrastructure, private real estate, and commodities. The hedge fund risk model is designed for the multi-asset, fund-to-fund hedge fund investor. It is intended to provide granular, insightful risk modeling in the absence of security-level custodial holding data. Where a client has this data, or indeed manages the hedge fund securities directly, Aladdin can model the risk of these investments from the bottom up, utilizing the full breadth of Aladdin's capabilities. Based on public market data, the factors cover both primary and secondary risks. Primary risk factors measure broad asset class performance, such as equities, rates, commodities, and currencies, while secondary factors measure intra-class biases, for example, value versus growth, high yield versus investment grade, and so on. The model also includes specialized style factors that treat commonly used hedge fund strategies, for example, merger arbitrage. On the next tab, we have a private equity portfolio. Private equity is considered fundamentally related to public equity markets with some distinct characteristics. Aladdin's approach to modeling private equity risk employs a comprehensive set of risk factors that private equity shares with public equity. These are risks associated with exposure to market, as well as sector, capitalization, and geographical concentration. In addition, private equity buyouts employ leverage while executing deals, which results in a higher risk level when compared to public equity investments. Next, we'll move on to the infrastructure model. The approach and structure of the infrastructure model is very similar to that of the private equity model. The focus of the model is to estimate economic risk for multi-asset investors allocating to unlisted infrastructure equity, rather than measuring the accounting risk that is reflected in periodic valuations, which is known to be smooth and low in frequency. The model will give clients the ability to estimate market risk across a multi-asset portfolio. Next, we have a real estate portfolio. The newest iteration of the real estate private equity model estimates the risk profile of private real estate from the perspective of a multi-asset investor. Emphasis is placed on economic risk rather than the accounting risk reflected in periodic valuations and appraisals. Risk factors are estimated using a statistical model that incorporates both public and private market data. As new and more granular data sources come online, this new approach permits such data to be incorporated naturally, extending the model's coverage. Exposures to risk factors are constructed from investment attributes that capture the economic features of a private real estate investment. Lastly, not pictures on the screen, the BRS risk model maps commodity futures exposures to the 1-month through 12-month contracts based on the maturity. This ensures a 100% exposure to the factors that correspond to the returns of the position contract for contracts maturing in the next 12 months. For contracts with longer maturity than 12 months, BRS maps them to the 12-month contracts. Each of these asset classes has a corresponding white paper detailing the premise, construction, and implementation of the model, which can be found on your client landing page. A further note about the alternatives risk model and the multi-asset capabilities of Aladdin's overall risk model is the fact that a correlation matrix can be constructed across all factors. This means that if I hold any of the alternative asset classes discussed, in addition to fixed income and public equity assets, I will see a diversification benefit from my broad asset class exposure. Correlations are determined by first calculating the covariance between each factor, which is derived from the time series of factor returns. The covariance is then normalized by the product of the factor volatility of each factor, producing a correlation coefficient between -1 and 1. Since the risk contribution is determined by considering the correlations between each factor, a multi-asset portfolio that accounts for such correlations will not overstate the risk of the fund. For this multi-asset fund, I see that there is a diversification benefit from the fact that the standalone risk differs from the risk contribution for each risk group. The public equity risk factors constitute the largest risk contribution, as the fund's NAV is over 50% public equities. Now let's dive into a few ways in which a risk manager might leverage Aladdin to go about their daily workflows. Aladdin offers several applications to assist in the risk oversight of multi-asset funds. As I do this, I will be executing the following jobs: determining the maximum amount my portfolio could lose with a given degree of confidence over a given time horizon, reviewing funds for any outsized changes in risk, comparing ex-ante risk to realized returns, checking manager correlations across my entire reporting structure, and engaging in risk budgeting exercises. Beginning in Explore, a flexible portfolio risk, exposure, and performance reporting tool, I can review funds across a large reporting structure for any deviations from a prior month-end figures. In the Portfolio Group Summary widget, here renamed to Manager Risk Drift, I can apply custom highlighting to quickly discern which funds have had outsized deviations in active risk since the previous month end. Active risk, or tracking error, is calculated by taking the difference in portfolio and benchmark factor exposures, and then using this exposure record to calculate the total risk. Essentially, it is a measure of the risk taken on by not matching the benchmark exposure record exactly. Said another way, it is the additional loss that your portfolio could incur relative to the benchmark by not matching the benchmark exposure record exactly. With this setup, I can see that the active port group risk contribution column has evidenced a 45 basis point change from the start of the month. Drilling in, it is clear that a large part of the change is coming from BRS EQ US1, which had a 33 basis point change as it contributes to the total port group. As a result, I'll need to review this fund in greater detail. Looking at the top level active risk and active port group risk contribution, I noticed that there is a discrepancy in values. The former reads 350 basis points, while the latter reads 330 basis points. This is because the benchmark risk and active risk columns in the Portfolio Group Summary widget are based on the assigned benchmark at each level of the portfolio group tree, whereas the corresponding contribution columns are based on the group aggregate benchmark. I can scroll down to my sector weight change bar chart to maybe get some insight into group level changes in sector weights that might be responsible for changes in my tracking error. Here, it appears that there was a large change in FX positioning from the beginning of the month until today, but nothing so drastic as to instantly link it to the observed tracking error shift. To more quickly discern which security might be contributing to the change in BRS EQ US1, I will move to a single portfolio context in Explore. Here, I have set up a risk and exposure widget renamed as Security Level Position and Risk Changes, and have sorted it by biggest delta in tracking error from the beginning of the month until now. With this, I can easily see which securities have engendered my tracking error shift. By increasing exposures relative to the benchmark on select assets, my fund has started to exhibit a great deal of tracking error. I like to see if these bets have paid off by observing the performance of this fund over the past month. Ultimately, if the bet has paid off, it might be interesting to see if I can hedge the excess risk incurred by allocating from an underperforming fund to a fund that has a negative correlation with BRSEQ US1. If the bets have not paid off, then it might be worthwhile to allocate from BRSEQ US1 to a higher performing fund that has little to negative correlations with the larger book of assets. In this way, Aladdin can help users actively manage a risk budget. To begin this analysis, I will look at a return analysis widget filtered on Intel, NVIDIA, and Micron. Pretty quickly I can see that this was not a wise bet, with returns being clearly negative on all three assets. Looking at a return analysis widget by portfolio in my portfolio group report, I can see that BRSEQ AP1 and BRSEQ US2 have generated the most amount of returns as they contribute to the total portfolio group returns. To see the correlations between these and all portfolios in the group, I will move into Portfolio Risk Tools, otherwise known as PRT. PRT allows users to conduct detailed risk analyses, provides comprehensive stress testing capabilities, and hosts a great deal of risk factor data. By looking at the correlations of these high-performing funds relative to the rest of the group, I can determine if it is worth allocating to these funds to obtain a diversification benefit. Since I want to ensure my tracking error is reduced, I will look at active fund correlations. To do this, I need to input the top-level portfolio group as well as the primary benchmark, and then select the correlation matrix report. In the report options, I will select the by portfolio option and change the dropdown to be level 3 of the portfolio group. The subsequent report shown on the screen evidences that the two highest yielding portfolios over the month, BRSEQ AP1 and BRSEQ US2, have opposing correlations with the top-level portfolio group relative to the benchmark. While BRSEQ AP1 has a correlation of 0.31, BRSEQ US2 has a correlation of negative 0.28. With this in mind, if I decrease my exposure to BRSEQ US1 and increase my exposure to BRSEQ US2, not only should my tracking error decrease, but my returns will also increase. To do this, I will expand this portfolio group in the composition panel of PRT, selecting to go to level 3 of the hierarchy. I will also select to do this relative to the global benchmark, meaning that the benchmark will appear as a singular line item in the composition panel that cannot be reweighted. The alternative option of breaking down a portfolio group will show each portfolio relative to the portfolio group benchmark, allowing for the benchmark to scale with changes in portfolio weights, most notably being applicable in leverage scenarios. After PRT loads the portfolio level contributions to the active risk, I will allocate a few percentage points from BRSEQ US1 to BRSEQ US2, creating an 11 basis point reduction in risk. I do also have a date range stress test loaded, simulating the parametric return across the fund structure from April 1st to April 26th, which results in a decrease in active stress P&L of 5 basis points. This, however, represents a relatively simplistic calculation over the time period, not accounting for changing exposures, which the return analysis widget in Explorer does account for. Thus, in order to improve the accuracy of the analysis, I will uncheck the constant exposure option in report options and run a stress P&L attribution report, as the composition panel will not update to reflect this change in methodology, only the report will. I have run this report as a batch request, as varying exposures through time will lead to longer run times. Batch requests run reports in a different manner, generating a link for easy access and helping to prevent timeouts that sometimes occur in a browser. I can see in the subsequent report that my active stress P&L with the reweighting is 187 basis points. If I were to run my portfolio without any changes, I would have a result of 75 basis points, showing that our reweighting exercise greatly increased our active stress P&L. As evidenced in this analysis, the Aladdin Risk and Reporting Toolkit provides a great deal of functionality for monitoring and investigating risk outliers, as well as conducting what-if total plan reweighting exercises. The application suite is able to report on both security and factor-based analytics, allowing risk managers to seamlessly review a broad set of funds with an outlier-based review process, taking points identified in this review and using them to conduct a series of what-if analyses on both the fund and group level.